Pursuant to Internal Revenue Service guidance, be advised that any federal tax advice contained in this program is not intended to be used, and it cannot be used by any person or entity for the purpose of avoiding any tax penalties that may be imposed by the Internal Revenue Service or any other U.S. federal taxing authority or agency, or promoting, marketing, or recommending to another party any transaction or matter addressed in this show. The opinions expressed by the host and the guests are their own and may not be used as authoritative advice. Any use of this material without the written consent of the host is strictly prohibited.
Welcome back. I am your host, Attorney Stephen Leahy, and this is the IRS Radio Hour on AM 560, The Answer.
Well, Uncle Steve, and for all of the Chicagoland listeners out there, this is the blog segment of the show, and really, Uncle Steve, what did you write about today, actually this week, in your blog?
Well, this week on the blog, remember last week on this show, the question...
Wait, this show that we just had?
On this show last week, who was the questioner? Do you remember who the questioner was?
1099.
The questioner. Who asked the question?
Oh, yeah, it was Rudolph Valentino from Toledo.
That's right, from Toledo.
My good friend of mine.
And I spoke about 1099-Cs on that segment last week. Mm-hmm. But what's happened since last week is I got a lot of feedback from that section, and everybody, and not only the feedback from the show, but also other people calling me this week. It's like it's an epidemic.
That's wonderful.
Because at the end of January, they start, all these companies start sending out these required IRS documents. You get your W-2 forms, you get the 1099s, and then the people are getting these 1099-Cs. And so I'm getting a lot of calls. What the heck is this 1099-C? Well, and I did explain it a little bit last week, but I wanted to go a little bit more into it this week.
Wonderful.
And that's what my blog post is, okay? So a 1099-C is a tax record that's sent by financial institutions to document the fact that they forgave a debt. So several years ago, the IRS required this form to be sent for anything over $600. So if you had a credit card debt and the credit card company forgave some of that debt, so I owed them $15,000.
Like you were talking about last week.
And they agreed to take $10,000. $5,000 is taxable. Well, while it's not good that I get taxed on $5,000, it gets worse. It can be worse for things like.
So I owe this guy $20, and he said it's fine. I don't have to pay him $20. Do I still have to pay that to the IRS?
That's a very good question, and the answer is. You're technically yes, because the IRS says even though this company say they forgave $500, they don't have to send me a 1099-C, but the IRS expects me to report it myself on my tax return. Mm-hmm. Okay, so now again, it's you're supposed to list it as income, but there's ways to exclude it or accept it. And there's 6 ways that the IRS lists. 3 are the most important, I think. The first exception or exclusion has to do with being technically insolvent. And technically insolvent means that my liabilities are more than my assets. Okay, so if I look at all the people I owe, and I add that all up, and then I look at everything that I own, and I add all those values up, if my debt is greater than my assets, well, then I'm technically insolvent. Now, according to the IRS, the 1099-C is only excludable up until the amount that I'm technically insolvent. So, for instance, I owe $150,000, and I only have $100,000 in debt. In assets. So now I'm $50,000 in arrears. If someone had given up $75,000, then I have to pay tax on $25,000. So I know I'm throwing a lot of numbers around, but it gets technical. That's why.
Yeah, my mind is all confused right now.
That's why if something like this happens, if you get a 1099-C, don't try to do the taxes yourself. This is where people get into trouble.
But who can I go to?
Well, you know who to go to. You go not Ghostbusters, Jimmy.
Oh,
you go to.
That's the first place I would have called.
Opem Tax Resolution. But now this is where it really gets. Now I mentioned one which was technically insolvent. The second exclusion is if you filed bankruptcy. So if I had debt forgiven because I filed a bankruptcy, well, then I don't have to pay taxes on that debt. It's not a 10. I don't have to include it as income, even if I'm technically solvent at the time. So that takes away that other requirement. Now, this really gets it really gets important when you're talking about short sales. And this is where, in my practice, this is where I see it a lot, in short sales or foreclosures. Because now you're talking about a lot of money. Okay, so I had someone.
How much money?
Well, again, it depends on the person. So last week I had someone come in. They owned several investment properties, and one was forgiven. Over $300,000 was forgiven.
Okay,
so
just
now
wiped away the.
Well, they forgave the debt because
Okay.
it was in a foreclosure, and now this is another confusing thing because if I get a 1099-C that says they canceled the debt, doesn't mean they can't come after me for it. I don't know. You figure it out. It's kind of confusing, isn't it?
I can't figure it out.
I know. That's difficult. But they're still going to send you a 1099. So now I have $300,000 in income. If at a 25% tax, it's a huge amount of money.
Yeah.
And now I've got to pay tax on it. Now, again, sometimes there's these two exclusions that I talked about. If I'm technically insolvent or if I file bankruptcy. And oftentimes, we talked a lot about deficiencies on this show before and how to avoid a deficiency. And one of the biggest ways to avoid a deficiency is bankruptcy. And that also avoids this whole 1099 problem. It doesn't avoid it to the sense that you don't have to report it. You still have to report it.
Okay.
And then there's another form. Let me finish this.
I'm sorry.
Because there's another form. It's not, and I'm going to tell you, it's Form 982, Jimmy. Is
982. Let me write that down.
I understand. So you have to include this form. So you have to add, like you would include your W-2 or another 1099. You have to attach it to your tax return. Now, in 2007, Congress passed a law. And the law is called the Mortgage Forgiveness Act. Okay, so the
Mortgage Forgiveness Act. Let me write that down. So what does that law include? Is it talking about maybe letting illegals stay here?
Okay,
legally?
so the technical name is the Mortgage Forgiveness Debt Relief Act. And this was in 2007 when everybody was losing their house and the price of property was falling like a rock, and everybody was losing their home to foreclosures and bankruptcy. So Congress passed this law that allowed you to exclude any forgiven debt based on your principal residence. So you didn't have to say, you didn't have to file bankruptcy to have it excluded, and you didn't have to be technically insolvent. So, this law went to 2012. Well, it was extended again in 2013. Well, so it didn't include 2014, which is the tax year we're talking about now. But in December 16th of just 2014, Congress passed a law and the president signed it to extend it to 2014. So again, if you had a short sale last year, you were on pins and needles until the end of the year when the Congress finally passed a law that let you get out from paying taxes on that forgiven debt. But if you didn't close, say I had a short sale pending and it didn't close last year, now it's closing in 2015. Well, that law doesn't apply in 2015. So now we're going to wait for Congress again to try to extend it
Why
again.
don't they just pass a bill that will just extend to several years in length?
Well, that would make sense, wouldn't it, Jim? I don't know why.
I don't even know why I asked that question. Just forget I asked that. Yeah.
That would make sense, but they didn't do that. And so now we're going to wait again in 2015 to see if Congress passes that, extends the law again.
On pins and needles again, waiting?
If I'm a homeowner and I do a short sale this year of my principal residence and I'm not technically insolvent, well then yeah, because it might make a huge difference. $80,000, $100,000 in taxes. So it's a big deal. It is a really big deal. So I'd say to you, we should get on the phone with our congressman and see if they can pass this, extend this law again. It makes sense that this law should be extended again. Because again, if I lose my house, then I'm going to get hit by the IRS with a huge debt from the biggest, baddest collection agency out there, who will never leave me alone for the rest of your life. Even in your death, they will not leave you alone. They won't let you sleep. They won't let you rest. They won't let you just do anything. That's true.
Well, who can I call? Who can I possibly call other than you? No, you. It's a joke. You. Should we call you for all this help?
Absolutely, because again, and that's not only if you're having foreclosure problems or if you're facing a short sale, because I help people with short sales also. I help people in foreclosure. But also, if you're just preparing your taxes and you get this 1099-C, Don't go to one of those big box places because this is where the problem comes in. They don't understand how to deal with these things. And so you need someone who's versed in this kind of stuff. And that's where Opem Tax Resolution.
Opem Tax Resolution can help you.
That's right. And the law office of Stephen A. Leahy, PC. Give us a call. We can prepare your 2014 taxes. We can help you if in your foreclosure. We can help you if you have IRS problems. And so give us a call, 312-664-6649. Visit us on the web at chicagotaxteam.com.
See you on the other side.
See you on the side.